$850 billion. That's not just a number on a spreadsheet. It's a loaded weapon pointed directly at your bank account. And, as of this morning, the finger on the trigger belongs to China. For years, people said a total collapse of the bond market was just a conspiracy theory. They said it was impossible. But right now, we are watching it move from impossible to inevitable. This is a geopolitical divorce between the world's two biggest superpowers, and it is going to force a price reset on every single thing you own. The 30-year mortgage rate is about to detach from reality. It's going to skyrocket, and there's nothing the Federal Reserve can do to stop it. If you thought 7% interest rates were painful, you are not ready for what happens when the biggest lender on the planet decides to walk away from the table. To really understand why this destroys your buying power, you have to look past the headlines. Most analysts only look at one number: Chinese holdings of standard U.S. treasuries, which sit around $760 billion. But that's not the whole story. When you add in the debt of U.S. agencies, massive entities like Fannie Mae and Freddie Mac, the real number is $850 billion. This is the leverage Beijing holds over the American economy. It's the nuclear option. For 2 decades, we had a deal. It was a symbiotic relationship. China sent us cheap goods, electronics, clothes, furniture. In exchange, we paid them in IOUs called treasury bonds. Then they did something very specific. They took those dollars and recycled them back into our debt market. They loaned the money right back to us. This kept our interest rates artificially low. It kept their currency cheap so they could export more. It was the greatest financial trade in history for the American shopper. It effectively subsidized our entire standard of living. But that trade is over. The trade war that kicked off in 2018 broke the cycle. It turned a partner into an adversary. When the U.S. put massive tariffs on Chinese goods, we basically told them their dollars were no longer welcome here. So China did the logical thing. They stopped recycling those dollars into U.S. debt. Instead, they started selling. The latest data confirms it. China is dumping U.S. assets at the fastest pace we've seen in years. This isn't an accident. This isn't a random fluctuation. It is a strategic decision by a foreign government to de-dollarize its entire economy. They are selling U.S. treasuries, which are just paper promises, and using that cash to buy physical gold. They've been buying gold for 28 months in a row. That's a record. They're trading paper from a potentially hostile government for a hard asset that has no counterparty risk. They saw what the U.S. did to Russia's reserves in 2022, freezing their accounts overnight. China is ensuring that can't happen to them. But here's where it gets dangerous for you. The problem isn't that China is buying gold. The problem is that nobody else is buying the bonds China is selling. The U.S. government runs on debt. We have a $2 trillion annual deficit. That means the government spends $2 trillion more than it makes in taxes every single year. To keep the lights on in Washington, we have to sell billions of dollars in new bonds every single week. It's like having a credit card bill that you pay off by opening a new credit card. In the past, China would show up to the auction and buy a huge chunk of that debt. They were the guaranteed buyer. Now, not only are they gone, but they're also dumping their old bonds onto the market. This creates a supply shock. Imagine a neighborhood where every single house goes up for sale on the same day, but there are 0 buyers. What happens to the prices of those houses? They crash. The bond market works the same way. There are now more bonds for sale than there are people who want to buy them. When the supply is higher than the demand, the price of the bond collapses. And here's the rule you need to memorize. In the bond market, price and yield are like a seesaw. When the price of the bond goes down, the interest rate, or yield, goes up immediately. This is why you're seeing rates spike. Inflation might technically be cooling down, but the market knows the truth. There is no major buyer left to absorb all this new debt. The Federal Reserve is doing quantitative tightening, which means they are selling bonds, not buying them. American banks are already full. They hold too much government debt and are sitting on massive unrealized losses. Japan is struggling to save its own currency, so they are selling U.S. treasuries too. That leaves the American investor, you, as the only one left to fund the government spending spree. But to convince you to buy a 10-year bond, the government has to bribe you. They have to offer a much higher interest rate. This creates a crowding out effect. It forces yields higher across the entire economy. It impacts every loan, every credit card, and every car note. But the most direct impact is on your house. The 30-year fixed mortgage tracks the 10-year Treasury yield. If China's selling pushes that yield to 6%, mortgage rates mathematically have to approach 9%. That's the math, and it's inescapable. We are seeing something terrifying, a complete decoupling. The mortgage rate is divorcing the Federal Reserve. Think about what that means. We're taught that the Fed sits in a control room and steers the economy. That is becoming less and less true. The Fed only controls the short-term rates. The market controls the long-term rates. The Fed could hold a press conference tomorrow and cut rates to zero. But if China dumps $50 billion in bonds on the same afternoon, your mortgage rate will go up, not down. This neutralizes the Federal Reserve. It effectively breaks their ability to save the housing market. We are entering a new era. Economists call it fiscal dominance. In plain English, it means the size of the government's debt pile matters more than the central bank's interest rate policy. And make no mistake, this is a new kind of war. But it's not fought with missiles or tanks. It's fought with math. And right now, they're pressing that button. The financial landscape is changing faster than ever before, and understanding these shifts is the first step to protecting yourself. They are the epicenter of the earthquake. You need to rethink everything you thought you knew about money. Holding a long-term US government bond used to be the safest investment in the world. Now it's a massive gamble. You're essentially betting on world peace. And if you've been watching the headlines from Taiwan or the South China Sea, peace is not what's happening. An $850 billion sell order is not some distant threat. It's happening right now. The US dollar is being systematically strangled by the very nations that helped build its global dominance. But before I tell you exactly which 3 assets you need to own to survive this coming crash, you have to understand the mechanics of the explosion. You have to understand the financial plumbing. Usually, financial plumbing is boring. Nobody cares about it until the toilet backs up and floods the entire house. Then, suddenly, it's the only thing that matters. Right now, a critical valve in the US financial system has just run dry. It's called the reverse repo facility. Think of the reverse repo like a giant emergency water tank for the economy. For the last 2 years, this tank was full. It held over $2 trillion of extra cash. It was a shock absorber. When the government needed to borrow huge sums of money, it could just dip into this tank. This allowed the US Treasury to sell trillions in new debt without completely breaking the market. It kept interest rates stable. It was our cushion. But as of this month, that cushion is gone. The tank is empty. The needle is on E. That $2 trillion. This means the era of easy money is gone forever. Now, every single dollar the government borrows has to come from somewhere else. It has to come directly out of the banking system. It has to come from your bank's reserves. And this is happening at the worst possible time. It's a perfect storm. We are hitting a liquidity cliff at the exact same moment China is dumping $850 billion in US bonds. Imagine you're driving a car, speeding up a steep hill. Suddenly, you run out of gas, and at that precise moment, someone slashes all 4 of your tires. That is the US economy right now. Without that cash buffer, banks are scrambling for cash. This puts immense pressure on regional banks all across the country. Do you remember Silicon Valley Bank? Do you remember how fast it collapsed back in 2023? That was just the movie trailer. We are watching unrealized losses spread like a virus through the entire banking system. Here's how it works. But when interest rates go up, the value of those old bonds goes down. It's simple math. According to the FDIC, American banks are currently sitting on over $600 billion in these paper losses. That's $600 billion that has just vanished, vaporized. But the banks are using a loophole. As long as they don't sell the bonds, they don't have to officially admit they lost the money. They can just pretend everything is fine. They can hide the massive losses on their balance sheet. But there's a catch. If you get scared and you go to the ATM to pull your money out, the bank has to pay you. To get that cash, they are forced to sell those bonds at a huge loss. And because the bonds might be worth 40% less than what they paid, they lock in that loss and instantly go bust. This is exactly what happened to Silicon Valley Bank. But now the risk is everywhere, and China knows it. By selling their bonds, China is deliberately forcing interest rates higher. When rates go higher, the hole in the bank's balance sheets gets bigger and bigger. It's a calculated strategy. Beijing knows that the banks are the Achilles heel of the US superpower. If the banks are broke, they can't lend money. If they can't lend money to businesses, the economy stops. It grinds to a halt, and the Federal Reserve is trapped. They've lost their magic wand. In 2023, they launched a massive rescue program called the Bank Term Funding Program. It saved the banks back then, but that program has now expired. It's gone. This leaves the Fed with a binary choice. Option 1, let the banks fail. Let the ATMs stop working. Let chaos reign. Option 2, print trillions of new dollars out of thin air to cover all the losses. If they choose option 2, they completely destroy the US dollar. They rob your savings through hyperinflation. Both options end in pain for the average American. But the attack isn't just happening in the bond market. It's also happening in the energy market. And this is the part that should truly scare you. For 50 years, the world operated under a deal called the Petrodollar system. It was simple. If you wanted to buy oil anywhere in the world, you had to use US dollars. If France wanted to buy oil from Saudi Arabia, France had to buy US dollars first. This created a permanent artificial demand for our money. It forced the world to hold our currency. That era is ending. China is now the world's biggest oil customer, and they are paying for that oil in their own currency, the yuan. They're using swap lines with Saudi Arabia. They're cutting side deals. They're building a pro-yuan alliance. They're cutting out the middleman, and the middleman is us. This drastically reduces the global demand for dollars, right when we need people to buy them the most. For the first time in decades, Saudi Arabia is openly cheating on the US dollar. For 50 years, the Saudis were married to the dollar. If you wanted their oil, you paid in American cash. End of story. But now, they're seeing other people. They're accepting other currencies. This is a direct attack on what economists call our exorbitant privilege. Think of it like a magic credit card with no limit. For decades, America has been able to run up massive debts without ever really paying the bill, simply because everyone needed our money to buy oil. That magic credit card just got declined. If the world needs fewer dollars to buy oil, they have zero reason to keep stashing US Treasury bonds in their vaults. This shift is not an accident. It lines up perfectly with what China is doing. It's a classic military strategy known as a pincer movement. Imagine an army being attacked from the front and the back at the exact same time. China is attacking the dollar from the supply side by dumping its bonds, and they are attacking from the demand side by buying oil in yuan. They are squeezing the US dollar to death from both ends. The impact is already hitting the market. They are demanding much higher payments to hold US debt because they realize a scary truth. The US government has no real plan. Well, actually, they do have a plan, but it's a terrible one. The plan is to borrow new money just to pay the interest on the old money. In the criminal world, we call that a Ponzi scheme. In Washington, they call it fiscal policy. But a Ponzi scheme only works as long as new money keeps coming in. When your biggest investor, China, calls your bluff and walks away, the whole thing starts to unravel. We're already seeing the cracks. This is when the US Treasury tries to sell new debt, and basically nobody shows up to buy it. The big banks, known as primary dealers, are being forced to step in and buy the unwanted bonds. This creates a liquidity trap. Imagine trying to sell your house, but the front door is nailed shut. You can't get out. In this environment, a sudden shock, like a war in Taiwan, could cause the entire bond market to seize up instantly. And here's the scariest part. US Treasuries are the collateral for the entire world as financial system. If the Treasury market freezes, the global financial system freezes. The ATMs stop working. The credit card machines go dark. The Federal Reserve is terrified of this. They're already talking about slowing down their own bond selling, but that's just putting a tiny band-aid on a massive gunshot wound. It doesn't fix the real problem. The real problem is simple. The US government spends way too much money. It's an addiction to debt that is now reaching its terminal phase. The world is losing faith, and the consequences will be felt by everyone. So, how do you protect yourself? How do you prepare for a world where the dollar is no longer king? The first thing you need to understand is that traditional safe havens might not be safe anymore. The rules of the game have changed completely. You need assets that are outside of the traditional banking and government system. You need assets that can't be printed, can't be devalued, and can't be easily seized. Here are the 3 assets you need to seriously consider right now. Have you ever wondered why everything suddenly feels so expensive? The gas pump, the grocery store, even your car insurance. It's not your imagination. You're paying for something you never voted for, a stealth tax called inflation. For decades, the US government spent money it didn't have, and it borrowed that money from its enemies. But now, those enemies, like China, have stopped lending. So, to cover the spending, the government has to print money, which makes every dollar you own worth less. The Chinese government is playing a very smart, very dangerous game. They're forcing the US into an impossible choice: hyperinflation or a Great Depression. They're betting that American politicians are weak and will always choose inflation to avoid immediate pain, even if it destroys the country in the long run. And if you look at history, that's a pretty safe bet. So, here's what's likely going to happen. The Federal Reserve will eventually pivot. They'll get scared, fire up the money printers again, and call it something fancy like market functioning support or yield curve control. Don't be fooled, it's just more money printing. This might save the banks for a little while, but it will crush the currency. We are heading towards a future where the dollar loses its value faster and faster. This is why you're seeing the stock market go up. But be very careful. It's not rising because companies are doing better. It's what I call the Venezuela dynamic. In Venezuela, the stock market went up by millions of %. Why? Because their money became worthless. If a loaf of bread costs $1 million, the bakery's stock price looks incredible, but you're still starving. That's what's happening to the S&P 500. It's only rising in name because the dollar is collapsing against real things. Investors are fleeing cash. They're desperately looking for anything that will hold its value. But here's the problem. The safe asset of the last 40 years, the US Treasury bond, is now the most dangerous place to be. The classic 60-40 portfolio is broken. For the first time in a generation, stocks and bonds are falling together. China has exposed the glass jaw of the entire Western financial system. They showed the world that the so-called risk-free rate is actually full of risk. And now, other countries are following their lead. The BRICS nations, Brazil, Russia, India, China, and South Africa, are building their own financial club. They're creating a new payment system to get around the US dollar, and they are hoarding gold at a rate we've never seen before. They are preparing for a new world order, where trade is settled with hard assets, not paper money printed out of thin air. Suddenly, the US is finding itself isolated. We used to be the king of the chessboard, but now we're losing pieces, and the American consumer is the one left holding the bag. Your standard of living was artificially high because the dollar was king. As the king loses his crown, everything we import gets more expensive. Your purchasing power is evaporating right before your eyes. Remember the China price? For 20 years, cheap Chinese labor kept your cost of living down. You could buy cheap electronics, cheap clothes, cheap everything. That era is over. It's been replaced by what I call the war price. Companies are in a panic, moving their factories out of China and into places like Vietnam and Mexico. Politicians call this friendshoring. It sounds friendly, but it's incredibly expensive. We're shifting from just-in-time efficiency to just-in-case safety. And safety costs money. A lot of money. Guess who pays that bill? You do. This is where it gets really dangerous. The US economy is 70% consumer spending. If people stop shopping, the whole thing collapses. The only reason people are still spending is because they feel rich. Their house value went up. Their 401k looks good. Economists call this the wealth effect. But here's the nightmare scenario that keeps central bankers awake at night. If China keeps selling our bonds, it could crash the bond market. That would send mortgage rates soaring to 9% or even higher. If that happens, the housing market crashes. When the housing market crashes, that wealth effect disappears overnight. People will feel poor, stop spending, and the economy will freeze. This triggers a doom loop. A bond crash leads to a real estate crash. That leads to a recession. In a recession, people pay less in taxes, which makes the government deficit even bigger. To pay for that bigger deficit, they have to sell more bonds. But selling more bonds makes the bond price crash even more. It's a death spiral, and China is feeding it. Every bond they sell accelerates this crash. It's cold, it's calculated, it's like a medieval siege. They're cutting off the supply of cheap money to the fortress. And inside the fortress, the leaders are lying to you. They tell you the economy is strong, but the foundations are rotting. Look at the official numbers. They release a great jobs report headline, then quietly revise it down months later, admitting the jobs never existed. They tell you GDP growth is strong, but it's all fake. It's driven entirely by government credit card spending, not real production. We're borrowing money to buy fake growth. The math is broken. For every new dollar of debt we take on, we're getting less than $1 of growth in return. We're spending $1 to get 50 cents back. That's a losing trade. And now that interest rates have tripled, the credit card bill is coming due. The interest payment on the national debt is growing exponentially. Soon, it will consume the entire federal budget. That means no money for roads, schools, or bridges. Every tax dollar you pay will go to Social Security or interest on the debt. This is the straitjacket China has put us in. There is no wiggle room. If a recession hits now, the government can't save you. They can't afford another round of stimulus checks without completely destroying the dollar. We are flying without a parachute, and the ground is rushing up to meet us. The bond market is that ground. It's hard, it's unforgiving, and it does not care about your feelings. The bond vigilantes are back, and they want their pound of flesh, and that flesh is going to come from your retirement account. The great wealth transfer isn't a conspiracy theory, it's simple mechanics. When a government can't pay its bills with taxes, it pays them with inflation. Inflation is a tax on your savings. You work hard for your dollars, you save them, but the government prints them for free. Every time they print a new dollar, the ones in your pocket become worth less. They are stealing your time and your labor. China understands this perfectly. That's why they are leaving the casino. They refuse to hold a currency that is designed to fail. And they are not alone. The smartest money in the world is running for the exits. We are witnessing a slow-motion bank run on the US dollar, happening at the highest levels. According to the World Gold Council, central banks are buying more gold now than they have in over 50 years. They aren't buying it because it's shiny. They're buying it because it's the only neutral asset left. In a world of financial warfare, gold is the only money that can't be frozen by sanctions. It's the only asset that isn't someone else's promise. The People's Bank of China is leading this charge, converting their trade profits into physical gold. But they aren't just buying gold, they are buying something else, something much more practical for the future, and if you want to protect yourself, you need to understand what it is. They are getting ready for a post-dollar world, where you don't pay with promises, you pay with real things. It comes down to a basic economic rule called Gresham's Law. Bad money drives out good money. Right now, the endlessly printed US dollar is the bad money. Gold and other real assets are the good money. But there is a way to navigate this. 3 specific assets have historically survived this kind of currency collapse. I'm going to break them down for you, step by step, so you can position yourself before the real panic begins. But first, we need to look at the doom loop that's already starting in the house. Have you ever noticed how the nations that actually make things, like cars and microchips, are hoarding gold? Ignore what the bankers say in their press conferences. Watch what they do. They'll tell you gold is a barbarous relic, that it's old-fashioned, and that you should trust paper money. But then, they go right back to their vaults and stack gold bars faster than ever before. They are lying to you. They're front-running the collapse because they know the old rules are dead. That 60-40 portfolio you've heard about? It's a zombie. It's walking dead. For 40 years, bonds were your safety net. If stocks crashed, bonds went up. But in an inflation crisis, that safety net disappears. Stocks and bonds can crash at the same time. There's nowhere to hide. We saw a preview of this back in 2022. Now, we're about to see the full movie. Holding a US Treasury bond today isn't a risk-free return. It's return-free risk. Just think about the math. You get paid 5% interest, but inflation is eating away 7% of your purchasing power. You are locking in a guaranteed loss. You are literally paying the government to lose your money. So, Where does the smart money go? When the dollar starts to burn, where do you run? You run to hard assets, things that can't be printed out of thin air, things a politician can't ruin with a signature. I'm talking about productive farmland, energy pipelines, copper, lithium, and of course, gold. These things have real, tangible value. They survive because you need them to live. This is exactly what China is doing right now. They're on a global shopping spree, buying copper mines in Africa and farmland in South America. They are trading their dying dollars for real dirt and real metal. They are converting their paper wealth into real wealth before the music stops. Now, take an honest look at your own net worth. How much of it is actually real? If all your money is sitting in a bank account or a 401k, you are vulnerable. You're the one left holding the bag for the government's massive debt. The everything bubble was built on cheap credit. The everything bust will be caused by expensive credit. It's like gravity. If interest rates stay at 6%, stock prices have to come down. The math just doesn't work otherwise. You can't have record high stock prices when money is this expensive. A reversion to the mean is coming, and it's going to be painful for anyone who's just passively sitting by. This is why billionaires like Zuckerberg and Bezos are selling their tech stocks. They're buying land. They're buying gold. They are moving down the risk pyramid because they want to be closer to the base of reality. They know that in this environment, speculative assets get wiped out. You need to become your own central bank. You need to hold reserves outside the traditional system. And here is the single most important rule for the next 10 years. If you can't touch it, you don't own it. If you have a gold ETF in your stock portfolio, you do not own gold. You own a piece of paper, a promise from a bank. And if the system crashes, that bank can just pay you out in worthless cash. They call it force majeure. It's legal and they will do it. China understands this perfectly. They are taking physical delivery of their gold. They don't leave it in London or New York anymore. They're bringing it home. This is draining the vaults and creating a massive squeeze. Soon, we're going to see a price split. There will be the paper price you see on TV, and then there will be the real price you have to pay to get a physical coin in your hand. The premiums are going to explode. We're already seeing this happen with silver. The market is screaming that the paper price is a lie. The same danger applies to housing. Real estate is a hard asset, yes, but it's a hard asset wrapped in a debt bomb. If you own a home or want to buy one, you are on the front lines of this war because the mortgage market is about to freeze. If you own your home free and clear, congratulations. That's a great inflation hedge. But if you have a massive mortgage, that house becomes a liability. It's a trap. Even with a fixed 30-year rate, you have a problem. Your insurance is skyrocketing. Your property taxes are exploding. These are costs that act like a variable rate mortgage you can't control. And it's going to get worse. Local governments are broke. The commercial real estate crash has destroyed their tax revenue. Empty office towers don't pay taxes. So where will the city find that money? They're coming for you. They're coming for the homeowner. They will raise your property taxes aggressively to fill the hole in their budget. Your home is turning from an asset into a tax farm for the government. It's not the perfect shield it was in the 1970s. You have to be smarter. You have to be agile. You need liquidity. But in a crisis, liquidity does not mean cash. Cash is trash. Liquidity means owning assets that anyone, anywhere, will accept. Gold is the only asset that is liquid in every country, in every currency, and in every crisis. It is the universal language of value. It requires no translation, no electricity. It works in a blackout. It works in a war. This is why China is buying it. It's their insurance policy. They are building a great wall of gold to protect their economy. You need to do the same thing for your family. Don't wait for the Federal Reserve to give you a signal. They will never tell you to panic. By the time they admit there's a crisis, it will be too late. The gates will be closed. They will try to lock you into the system. This is where the central bank digital currency, or CBDC, comes in. This is the ultimate trap. It allows them to track every penny you spend. It allows them to stop you from buying things like gold. It even allows them to impose negative interest rates, which means they can take money directly out of your account just for saving it. This is the end game. This is financial repression. They need you to stay in the dollar so they can inflate away their debt. If you exit the dollar, you defeat their strategy. so they will try to stop you. But right now, the door is still open. You can still walk through it. You can still convert your digital numbers into real tangible assets. No penalties, no restrictions, yet. This window will not stay open forever. China's massive sell-off of US debt is just the first domino. It will knock over the bond market, then the stock market, and then the currency itself. We are watching the death of the old system. The transition will be chaotic and volatile, but wealth is never destroyed. It is just transferred. It moves from the hands of the unprepared to the hands of the prepared, from the oblivious creditor to the smart owner. You have a choice. Will you be the creditor who gets paid back in worthless paper? Or will you be the owner who holds the things the world actually needs? China has made its bet. They are betting against the dollar. They are betting on the laws of mathematics. I suggest you look at the math yourself. Do you really want to be on the other side of that bet? The storm isn't coming, it's here. It's overhead, the roof is leaking. It's time to build your ark and load it with hard assets. But knowing what to buy is only half the battle. You need to know when the final collapse will trigger. There is one specific red line indicator that predicts exactly when the Federal Reserve will be forced to print money again. It has predicted every single crash since 2008, and it just flashed red this morning. Click the video right here to see the chart that scares the Fed the most. I'll see you there.